All right, so welcome back again. I have to scan through some few areas with you. First, let me complete the consolidation P&L or comprehensive income. All right, so console P&L, the consolidation is not difficult, but it requires few issues. Now, there's a question in here called Space Phone Bars and Kasapa Limited. So first, you go to the requirement and be sure that it is consolidation. Before you know, they're asking you to do ratios. Good. It said calculate the goodwill arising on the acquisition of bus by Space Phone, and the goodwill amount that should appear in the consolidated financial position of Space Phone as at 31st October 2017. Yeah, the examiner wants you to do the goodwill at acquisition and goodwill at reporting. And over here too, second requirement say we should prepare consolidated statement of profit and loss account for Space Phone Group for the year ended 31st October 2017. Now we are done with the requirement. So what you have to do is that ordinary, if it is only consolidation of profit and loss, we don't need goodwill stuff. But most of the P&L questions will give you consolidation of P&L, and we still ask you to do goodwill. So in that case, it will require you to calculate the goodwill. So question of this nature, this is how you have to start. So still my question one. A my goodwill. Then I'll go to the B. Still question 1B. Then I write the name of the company, Space Phone Group. Space Phone Group. Then I say consolidated. For the year ended, what's the ending year? 31st October 2017. Where would the year start from? If we are ending 31st October 2017, where are we starting from?
September 2016.
Good. So September 2016. 31st October 2017. Then the reporting currency from the question. Reporting currency, how they've written it. Ghana cedis in millions. That's all. The entire page is for P&L. Don't write anything. You see, the entire first page is for my goodwill. I didn't write anything there. My next page is for entire P&L. This is how you have to do it for us. It will give you enough space to do all your adjustments. All right, so close it. Now when you're done, you're going to do your workings one. First, your workings one. Still question one, your workings. So all figures are in Ghana cedi of millions. Then you start workings 1A, group structure. So you have to write a parent name here. Space phone. Then let's go and read where the acquisition stories are. But let me show you something in the question. Oh, it's gone. All right, so what happened is that we are going to read to establish the group structure. Once you establish the group structure, you are good to go. They say Space Unlimited, in its quest to gain dominance in the telecommunication industry, bought 80% holding in equity of BAS and 40% equity holding in Kasapa. All of them, they are on July 2017. So you go and write BAS and Kasapa. Yes, 80% and yes, 40%. NCI, that's all. Number two, effective, that's the question. 1B, effective date of acquisition. Effective date of acquisition. This is the first thing you have to do. In console, this is where we start from. Effective date of acquisition, I think they say 1st July or so. 1st July 2017. So count for us. 1st of July for that of bus, 1st July 2017. And for that of Kasapa, they say 1st July 2017. Please, 1st July 2017 to 31st October 2017. How many months?
Sir, please, 4 months.
4 months.
4 solid months. Okay, that's so good. So that will appear under the period of consolidation. Still working so 1C. Right on top, period of consolidation. Period of consolidation. What is the period of consolidation? They say 4 months. This one you make it associate. Kasapa right on into bracket associate. Because 40% amount to associate. So the third examiner 8 months. Consolidation for who? Space phone. And
Sir, please, it's not 8, it's 4.
is it 4? Eh?
Yes.
Okay. That is July, August, September, and October. So 4. So you write here 4 months consolidation. For bus. For Kasapa 2, 4 months associates. For Kasapa. Now that you are done like this, you are sure. You go and consolidate. That's all. Don't read any story again. Don't waste your time and read everything here. No, you're wasting time. Go straight to your start the consolidation. Parent own plus 4 months of bus. Parent own plus 4 months of bus. So you do like that, one after the other. Parent own plus 4 months. So this is how you should do it. So you have revenue 428 minus 2448. 428. Let's go revenue. So even when they ask you to do the goodwill, you are doing the B, the consolidation first before the goodwill. Go and do the goodwill later. So revenue, open a bracket. What's the parent revenue? 4428. Plus 4 out of 12 times. What's the revenue of the subsidiary? Bus 2448. So what do you get?
But wouldn't any of the notes affect the revenue?
That it has to close it. No, please, it's against the rule. We don't close it now. So you just open it like this, go to cost of sales and do the same thing. But we have not even read any of the footnotes. So definitely it will be highly affected. So you go to cost of sales, you do the same show, 1674. 1674, 1674. Plus 4 out of 12 times. Then you continue. Now, once there's associate, there are key issues I want you to take notice of. A64, the next one, you get your gross profit. You consolidate. I'm done. So you do line by line consolidation. So take notice. Please, you consolidate line by line. Let me show you what you have to do somewhere here. Operating expenses to consolidate. Parent owned plus 8, 4/12 out of this. Finance cost consolidate. Other income consolidate. Investment income consolidate. But before the profit after tax, leave additional line here. Here the finance cost came early. Leave additional line here. Anytime there's associate, create additional column and call it profit from associate. Profit from associate. That is the only foreign material, foreign stuff, foreign account you must open. All right, so that is all. Then continue your consolidation. The answer, get profit before tax. Tax is always free. So this one, when you do tax, you can just put your answer there. You get your profit for the year. Consolidate the gains on revaluation. Consolidate all of them. Then when you are done with the total comprehensive income, then this is what you do for us. Please. So let me do the Finish your continuing. Total comprehensive income. So here you continue Total comprehensive income, that means that's the end of your consolidation. You are done. Then you come and share the profit. So the next line, you say share of profit for the year. Attributable to profit for the year. Normally, profit for the year, it's very plenty. So I normally write share of profit after tax attributable to owners of NCI and then parents. Then you also come and write total comprehensive income attributable to, that's the share of profit, total comprehensive income attributable to owners of NCI and still parents. Many people don't share the profit. 2021, they asked them to share the profit. To try as much as possible to understand.
So sir, please, this one it will come after the profit for the year.
No, after the total comprehensive income.
Oh, okay. After total
After
comprehensive.
you are done with all your comprehensive income.
Oh.
After, I've done 3 dots here, meaning you do have to total comprehensive income before the next line. Then
Okay, sir.
you share the profit for the year.
Okay.
That's all. So with the consolidation issues, much that you can do. Then you can start with your footnotes. You're going to continue. Once there's goodwill in a question, you can decide that all my net asset, goodwill, I'll do everything on the face of the goodwill. Normally do it that way, you'll be saved. So once you start with the goodwill, you first have to start with your consideration. To start with your purchase consideration, cost of consideration. Then you go and look for it in the question. If you go, it's not there, you move on with the game. You need to reporting currencies. So we are now going to take our time and read the question slowly. You say that Space Phone Limited, in its quest to gain dominance in telecommunication industry, bought 80% holding in the equity of BAS and 40% equity shares of Casapa Limited. On July 2017, 1st July, the purchase price of the investment of BAS was agreed at 400, of which 1,600 million, 4,400 million, 1,700 million was paid in cash. The remainder was paid by issuing 800 million equity shares of one nominal value to the seller at their fair value of 3.5 each. All these stories, you don't need them. You don't need them all. But what you need is the purchase consideration, how much you paid for. How much you paid for. And they say you pay for 4,400. It's enough. But as to the breakdown, and here the only breakdown that we are interested in is, let's say, deferred consideration or contingent consideration, where changes in those considerations will create an additional workings in a P&L and then the balance sheet. So if you use share exchange, we are not doing balance sheet here. So share exchange computation won't affect what we are doing. If you like, multiply 800 by 3.5. What do you get? You get the same 1,006, but it's not necessary. You get a difference, but it is not necessary. We are just creating unnecessary workings for some people in exams. We just want to do that. They'll do as if they are working, but it doesn't call for any marks. For example, just pick your 4,400 and go as your purchase consideration. But some will say, okay, let me do something. Minus 1,006 will give you what? 4,400 minus 1,006.
$2,800.
Good, 2,008. Now multiply 1,600. Hey, multiply 800 by 3.5. What do you get?
2,800.
Yeah, so they will still be doing all this calculation for us in exam. So I see they are working, you know.
Can go up and down, son.
Yes, I see they are working, but what you need is 4,400. Just go and put it there and go. As to the breakdown, purchase consideration 4,400. Add NCI, fair value. No, wait, relax. Let them tell us that they are using fair value method before. So they said 20% of non-controlling interest of BAS had a fair value of 900 where you are at the date of acquisition. So 900 at the date of acquisition. So fair value of NCI 900. Add up, you get 5,000, 300. That'll give you a total consideration. The BAS net asset had a fair value of 4,700 at 1st July. That's all. 4,700. No, you see, this is not balance sheet, so the examiner cannot make goodwill calculation complicated. No, we don't do that. So less net assets, less net asset at where? Acquisition 4,007. Please, what do you get as the goodwill? What do you get as goodwill?
4,600. It's a
Are you sure?
600.
600.
Good. So goodwill is 600. That's we call goodwill at acquisition. Goodwill at acquisition is 600. But they ask us to find goodwill both at acquisition and at reporting. Most of your P&L questions, please read it careful. We only want goodwill at acquisition. Several occasions we have asked goodwill at acquisition, but they will do goodwill at reporting for us. Several occasions we have asked them goodwill at reporting, they ended at goodwill at acquisition. No matter what the situation be, you get something different as the answer in the exams. That is why it's ginger us to ask funny questions in the exams. Now, included in the fair value of the BAS net asset on the date of acquisition, some machinery owned by BAS carried at 90 million below its fair value. The revised fair value was not incorporated into the books of BAS, as BAS has not adopted a policy of revaluing machinery assets. The useful life of this machinery at the date of acquisition was estimated to be 6 years. Over here, it will still not affect the fair value figure. Once the examiner said this is the fair value of the assets, unless there's omission. But if there's an asset they use already, it will not affect the fair value given to you. What a wow. So take note of this. It's very important. So all what this one will affect is that it will affect your cost of sales. Nothing else, nothing more. Because it will create additional depreciation. So there's a fair value below. This one, take notice. The 90 million below its fair value. Will it be a gain or loss? When they say 90 million below, the current amount is below.
Say please is again.
Good. It's the same as fair value being excess of the current amount. So therefore, again, but this, because the examiner gave us the fair value, they didn't say the current amount of the net assets was 94. That net asset we used to calculate the goodwill was not a current amount, but rather was a fair value. Once you pick a fair value, you are saved. But once the examiner said is the current amount of the net asset at the date of acquisition is this, that one you are not saved. That one, in that case, when you come, you have to come and add this 90 to it. But where they say that this is the fair value, you can't do it again. So here, there's again, it won't go anywhere.
Say.
Yes, please.
So unfortunately for me, I'm part of the people that showed working. I'm part of the people that decided to do everything as if we are working again. Say please, me, I added it to the at acquisition because it was a fair value gain. So when I did everything, I did my depreciation and I did the URP. I got 4790.
Okay, so you see, you only add fair value to it when it is omission or when the net asset given to you is at carrying amount. Then you now add additional fair value. Once we say that this is the fair value of net asset, that means that's what you have to use. Any further fair value gain, it has been captured already. You get, unless it's omission, unless the examiner said that a particular asset was omitted from the list and it has a fair value of this. In that case, go ahead and go and add. But if the examiner is a fair value adjustment, no, we will not. It's a plain thing that we normally do. We are much aware, especially the level 2. Level 3, when we do it, they catch us. So we don't normally do it at level 3. It's a level 2 that we do it. So once you have gotten it, but you've gotten it, right?
Yes, please.
Okay, so once you've gotten it, that's all what you are looking for. All right, so only the depreciation aspect we expect you to place it in your cost of sales. So calculate the depreciation and add it to cost of sales. Let's all calculate the depreciation.
It's 15.
15.
So let's show working. Let's see how best we can calculate. Then you go and put it there for me. Then I move on with your storyline. So it will be 90 times divided by how many years left? 6 years. Now times what? 4 out of what? For P&L, even if they acquired the subsidiary 30 years ago, you still use 1. Because the cost of sales you are calculating is just 1 year. It's not for
It's 5 million.
it's 5 million.
Yes.
90 divided by 6. So
Yes. Times 4/12.
yes, times 4/12. What do you get?
It's 5 million.
Yes.
Do you agree?
Yes.
Yes.
The figure look too big for me. Oh. All right. So go to cost of sales and add 5 million to your cost of sales. So add 5 million to cost of sales. First thing you have to do for us, but here, if, only if this 90 has not been captured, then you only go and add it to the what we are. Did you
The
understand?
whiteboard is not showing.
Okay, so let's go to the whiteboard. Whiteboard. You see, here plus 5. Let's go there again, and then let me check something for you. So that Bar's net asset had a fair value of 4,700 on 1st July 2017. So they said net assets had fair value of 4,007. Then you come down again and come and tell us that included in the fair value of Bar's net assets on acquisition, included in the asset we picked on the date of acquisition, sum of machinery owned by Bas, but carried at 90 below its fair value. They want to change the thing. No? They say this one is included. Where is it? Included. So within the fair value of it, there was a particular item they carried. They didn't carry it at fair value. You get it? So in that case, you add the 90 to the fair value, call it fair value adjustment. So take notice of that. It means that included in the fair value per this caption given here. That means there's a particular asset within the asset list. They did not carry it at fair value. So we have to go and carry. So that means the fair value that they're giving us is incomplete. So it means that the fair value given to us, this fair value is incomplete. So here what you do is that you only come here to adjust it small. So Cassie, you are right. Just come here like this and add the figures together. Let me do it this way for you. I like doing this way. In this case, just say 4,700 plus the 90. So that'll give you 4,790. Which will be 560 or so, or 510.
510.
Okay, so that's good at acquisition. Then what you do next is continue the storyline. Look for impairment. So on that note, this entire note, you are done with it. It won't appear anywhere again. Look for where they said impairment. Look for impairment.
I'm getting confused. So I think
At this side, right?
Yes, he said included.
It means that it's an asset within and did not carry it at fair value. You see,
So meaning,
it's like this. During acquisition, you pick all your assets and add their fair value together, not the current amount. Do you agree? That is what we want. But here they say something. They say included in the fair value of the vast net assets. There's a particular asset called machinery. For that one alone, we couldn't find the fair value. So it was carried. It was carried, meaning this, look at this statement. It was carried at what? 90 million below its fair value. That means the 90 million was the carrying amount. So even though they said this is fair value, but they've gone and add carrying amount to it. Do you get it? Even though the examiner have given us the fair values to be 4,700, they said that there's a particular asset in it. We didn't choose the fair value. We chose the carrying amount. And the current amount is below its fair value by 90. Do you get it? So that is why we are bringing it to the story.
So, sir, please, the depreciation, the 5 million depreciation, will it still go to the cost of sales?
Yes, it will go to automatic. That one, even that one, whether it affects the net asset at acquisition or not, it will still go the automatic. Agreed.
Yes. Always, yes.
Automatic. Okay, so we have to look for where there's goodwill. Where there's goodwill. So you continue searching. If you see goodwill, let us know. Goodwill. They said that goodwill of BAS was reviewed for impairment. And it was found to have a recoverable amount of what? This was one of the craziest, one of the easiest, but it is found to be something else. Most people did not get this one right. It means that they are IAS 36 understanding is low. Impairment. What's the formula for calculating impairment? You compare what? Please.
Your carrying amount to the recoverable amount.
Okay, so if the carrying amount is, let's say, 24, and the recoverable amount is, let's say, 20, what's the impairment?
4.
So now if I tell you that I have an asset, the carrying amount is 24, and the recoverable amount is 20, that means you have to go and calculate what? The impairment yourself. So now they have given us a recoverable amount to be what? To be 400. So that means you have to go and calculate the impairment yourself. Go and compare this 400 to the current amount of the goodwill. So leave a space and come here and write the recoverable amount of 400 here. And tell the examiner, this is the recoverable amount. And this is a goodwill at reporting. So what's the difference?
110.
That's the impairment. So not always the examiner will carry that the impairment goodwill has been impaired by 10%. No. You are even lucky. Do you know that particular year, ACCA released a question, and in that question, they gave them the recoverable amount was stated as a percentage of the net assets to the final level. So 110, when I subtract, that becomes impairment. So impairment is charged to either admin. So add this figure to admin or operating expenses when you're doing your consolidation. Or sometimes the examiner will tell you where to charge to. They didn't tell us where to charge to. So if they don't tell you, go and add it to operating expenses if you're doing your console. So add it to operating expense. You are done. Continue with the workings. Continue with the footnotes. So on that note, 3 marks is gone. Now we've read the other notes. Let's read the note 2. As soon as I'm done with the notes, we are good to go. Note 2 says that the post-acquisition period. During the post-acquisition period, BAS sold goods to Space Phone for 50 million. Who made a sale?
The parent and the subsidiary.
50 million. These goods were sold by BAS at a profit of 30 pesos per every what? 30 pesos for every 1 cedi. So you can say that the profit margin is 30% profit margin, not markup. On the sale price, how much he sold it? So 30%. And 40% of these goods is still in inventory. So calculate the unrealized profit. First of all, the entire sale should be eliminated. So go and eliminate the entire sales. Entire sales should be eliminated. There's a particular footnote that says I should go through with you. It's in November 2016. Yes, November 2016. They say I should go and treat only one note to perform that question with you. Hey. Yeah. And they've showed another note again that I should treat those 2 notes with you because on Monday, all of them are featured in your question. So, calculate the unrealized profit for me. Let's start. It will be 30 pesos will be what? Convert 30 pesos to decimal. 0.3 divided
0.3
by 1 times 50 million times how many? The proportion of goods left in inventory.
40%.
Yes. So what do you get?
6,000.
Good. So you say plus 6. You add it to cost of sales immediately.
Target. Normally your screen a dark interface.
No.
Even in the recording, same I've been seeing. I don't know why.
Hey, then normally what happens is it's still there, right?
But it's gone.
Oh, okay. Then I should not be using this. I have to use the other one. I have to use this one. I have to be using the other software. Let me go and use it. Let me go and use this software. It's a software that's causing that. Come on. Okay, so let me use this particular one. All right, so here, what do you do? So let me use this one. 0.3 over 1 times 50 times 40%. What do you get? You get 6. Subtract, no, add it to cost of sales because additional expense. That's all, it ends there. Do you agree or don't agree? Do you agree so that I can go straight and discuss what they said I should discuss with you?
We agree, sir.
Come again.
We agree.
Okay, so next. They say since acquiring its investments in BAS, Space Fund has managed the administration of the entire group. I love this note. Take note of this. It's part of the note that will feature in your exams. Space Fund invoiced 4 million for its share of this cost to let me start again. Since acquiring its investment in BAS, Space Fund has managed the administration of the entire group. So we call it central administration. Good. Centralization. Space Fund has invoiced BAS 4 million for its share of this cost. Space Fund recorded this transaction within other income. BAS within operating expenses. So what do?
Please, we eliminate it.
Good. So you eliminate it, this intra-group. But there was something called share of head office expenses in transit. They are cash in transit, goods in transit, and share of head office expenses. The same November 2017 question is inside. November 2016, there's a particular note in that question. When we are done with this, I'm going to just scan you through those notes. And then the assignment I gave you, there's one particular note that I should come and solve with you. When I do that, then I've really ushered you to your nice exams. Then May 2017.
Please, which assignment? This one, the first one.
Yeah, easy.
Oh, okay.
Then they're also showing me May 2017 that there's something that I have to discuss. Oh, yeah, I've seen it. May 2017, Asuna Taba and Gantaba. All right, so all these are your questions. So I'm done with these notes. Let's go to the next notes. Note 4. Goodwill of BAS, we talked about it already. This one to you. We talked about it already. You see that how nice the thing is. Your question there, part 2 dear, part 2 consonant now. It's empty, but just that because you are new to consolidation at part 2, it can sound like it's something unjust to you. But when you go to part 3, you wish they could have given your console question back to you for you to solve. It's because now you've understood it. So that is that. So take it from each of them and then we are good to go. Now let's go to note 5. Oh, the last note. Oh. On October 2017, Space Fund sold some land to Kasapa.
Sir,
Yes.
sir, please, so the note I, the 4 million, are
Yes.
we taking it from cost of sales?
No. Look at where they have recorded it. Wherever they tie the goods, that's
Other income.
you untie. So number one person, Space Fund recorded it in where?
Other income.
To go there and subtract 4 million from other income. Whilst BAS recorded it in where?
Operating expenses.
So go there and subtract 4 million from there. You are done. You don't have a problem again.
Oh, okay.
But if you
Thanks.
decide to put it anywhere of your choice, we also decide to allocate the marks for you. Even though your final answer will be correct, we'll still mark you down. Because we intentionally told you where it has been recorded. And you decided to send it to a different place for us. We won't forgive you. They won't forgive you. When we don't tell you where they have recorded it, then you can decide that, oh, then let me take it to cost of sales, we'll mark it for you. Let me take it to operating, we'll mark it for you. Let me take it to other income, we'll mark it for you. Good. I'm done. They say on October 2017, Space Fund sold some land to Kasapa for 12 million. This particular note is inside the question I gave you, easy. It's inside easy. On October 2017, Space Fund sold some land to Kasapa. Who is Kasapa? Who is Kasapa?
Associate.
The associate.
Anytime parent or the group, either the parent or any of the subsidiary, made a sale or a transaction to associates. We call it downstream. When associates sell to parents or any of the subsidiaries, we call it upstream. That's why we don't eliminate the entire transaction because associate is outsider. The only thing we eliminate is unrealized profit. And don't forget to multiply by the parent shareholding. Don't forget. It is only unrealized profit that we take parent share. Hey, what a wow. It's only this one bill. So on 1st October 2017, Space Phone sold some land to Kasapa for 12 million and recorded profit of what?
8 million.
This profit is included within where?
Other income.
So what do? First, find the profit, 8 million. Next, do the elimination. Eliminate only the profit. The main transaction, leave it. The main transaction, you leave it. It's another income. What is the parent share? Don't forget that when it comes to associate, you can only eliminate your share. What is the parent shareholding in associate? Let's go and check percentage parent hold.
Sir, please,
40%.
40%.
So please take 40% of the 8. What do you get?
3.2.
3.2. What if it was a subsidiary? What do? Imagine it was a subsidiary.
So you find 20% of it.
The sales, the
Right.
sales.
So people want to jam up. You see, there was a subsidiary here who made unrealized profit. We calculate unrealized, but we had what?
Sus.
Did we take any percentage?
No.
So when there's unrealized profit between the group members or subsidiary and subsidiary, we don't take percentage. But if it was to be the associate, that one will take percentage. Agreed.
Yes, please.
Agreed.
Yes, please.
This is a secret that the examiners use. And I can see November 2016 moving around your paper because you also write in November. That is why they say this is November 2017. Oh, exactly 7 years ago. Exams the wrote. November 2016. Oh, exactly 8 years. So that is that. So I'm done.
Sir, please don't you do the 4/12.
Good.
Yes.
I love that. Please, unrealized profit. Let me repeat it. Unrealized profit.
Shouldn't be prorated, we said there.
No prorating for unrealized profit. We beg you.
Sir, I forgot.
Okay. Up Monday. You won't forget it too. Or you,
No, sir, I won't forget.
I come and ask you. I'm with this. So on that note, we are done. The only thing, let me calculate the share of associate profit for you. It's very easy. What's the associate profit made for the year? Associate, where you show yourself. Take the profit for the year. What's the profit for the year?
219.6.
Just multiply by the shareholding, that the percentage we owe. 40% times 219.6 times 4/12, right? Or first find 4/12 first. Then multiply by 2196. The answer multiply by 40%. That's the share of associate profit. That is all what you have to do. If you don't do this, you get trouble inside. If you don't do this, you get trouble inside. What do you get as the answer? What do you get?
29.28.
29.2. That's all. You're going to write it in your exams. On that note, I'm done with this question. The only thing I've not done is share of profit. That one, most people don't do it, and I understand them because mostly their profit after tax is wrong. So even if they further themselves to share, they will share wrong figure. And sharing wrong figure will amount to 0.2. So on that note, we are true. Next thing that I have to do with you is to go through that thing where they've done it once. Asuna Taba and Gantaba. Take me to Asuna as Gantaba and Asuna Taba. May 2017, question 1. Take me there. Take me there. There's a particular thing that I just want to show to you. Oh, yes. I saw it. Good. Asuna Taba and what? Gambetta. Okay. It's not Gantaba, it's Gambetta. Good. Now, question of this nature is very interesting. First thing you have to do for me, they ask them to do something. And let me go and read what they asked them to do. 1, they have to do consolidated financial position. That one you can do it, no wahala. Changes in equity, that is what I'm about to explain to you. If you go, they ask to do changes in equity, please, have you done some before? Have you done some before individually?
Yeah.
Now, when you go and they say do changes,
Yeah.
don't bother yourself to do it. Right on top, name of the company, Asuna Taba. Say consolidated changes in what? Equity. Tell the examiner that this is the same as group retained earnings and NCI. That's all. So recopy group retained earnings for him. Group retained earnings and then the NCI. So you can decide to do this. And when you're done, you add the group stated capital. That's all. So that is, so those who have not gone through it, don't worry yourself that, oh, target, I've not done changes in equity. Target, I've not done changes in equity. So it's a target.
Yeah.
Sorry. Yes.
Please, with the P&L that we just did, there's no group retained earnings anyway.
Do you want to calculate it? Let me ask this question first. Do you want to calculate it?
No group retained earnings.
Okay, Cassie and I see. Have you seen? Even what we have not asked, they want to do it for us. So we've not asked you group retained earnings. You see, group retained earnings must only be done when we are doing balance sheets. Financial position has 6 to 7 standard workings. Depending on 6 to 7 standard workings. P&L, where do you see group retained earnings in P&L?
Sir, there's no group retained earnings. For me, when I started the thing, I did the group structure. I did the net assets of the subsidiaries. Me call the NCI. Answer na me nya pen. Should I nya papa biya?
No,
Cassie, last that did you do group retain earnings?
No. Or
The
wait.
question was similar to this one.
Me, I did everything. No, what I knew from
no.
When this one is not giving, you see this one, they didn't give you statement of financial position.
okay,
Don't
so
even need to worry yourself and do group retaining.
that would take the plenty ones. So when they give me P&L, I should even do NCI.
Cassie, you need this. Let me do this one for you. Now, when you're doing P&L, most of your questions, P&L without goodwill, they didn't ask you to calculate any goodwill. Oh, then thank God, P&L without goodwill. That one, you don't need net assets. You don't need goodwill. You don't need NCI at balance sheet. There are two types of NCI. We have the one that go to balance. You don't need that one. You don't need group retained earnings. You don't need investment in associate. We beg you. But when they ask you that, oh, there's P&L with goodwill, then that one you need only to calculate the goodwill. In that case, don't waste your time to go and do a different workings for net asset, a different workings for your consideration, different workings for good. Don't do that. Look at this question, the question we just solved. They asked us goodwill. And we did consideration, we did NCI, we did net asset in all one goodwill calculation. In that case, it will be very simple for you to do it than to go and spend another time to do it. No, that one don't do it. We beg you, do it this way. Then, in that case, after the goodwill, nothing else again. After the goodwill calculation, no net asset, don't do a separate workings for net asset, no group retained earnings, nothing. We beg you. But when they ask you for financial position, aka balance sheet, everything must be there. Agree?
Yes, please.
Okay, I'm done with this.
Okay. So that means I have to take my time, Pam, because the only way I go to know that you have to add 90 to it is when I did the net asset too.
No, it's because of the goodwill. If not because of goodwill, we don't need those stuff. You know?
Yes.
If not because of goodwill.
So that
Yes, boss.
so you say when we are being asked to prepare the changes in equity,
Yes,
consolidated changes, when we are asked to prepare the consolidated changes in equity,
yes, please.
it will be the same as the group with share of the retained and NCI.
Yes, then add group stated capital to it, that's all. There's a way of doing it. But if you are not privy, if you have not done something before and you're asking you, don't bother yourself. Just do this. Recopy. Don't refer the examiner. Don't say that refer. No, copy them again. Because there will be additional mark for you. Copy your group return earnings again here. Copy your NCI calculation also here. Copy your group stated capital also here. That's all. When you're done, try and sum all of them up. It will give you the same answer as your changes in equity.
Say.
Yes, please.
To say, please, my question with this kind of thing, no, they'll only give you when there's balance sheet.
The changes in equity.
Yes.
Yeah, they can give you when there is that one we can ask at any time. I've seen an ACC examiner asking it even when they are doing P&L. So they can ask
say,
at any time.
So say when they ask you doing P&L.
That means they will give you a lot of information that will help you to do it. So when they ask you doing P&L, just go ahead and do your group retained earnings. Do your NCI that will appear on balance sheet. Do your group stated capital. That's all. Any there for him. Agreed. Okay. Take me to November 2016. Abrimpo. Bantama. There's a question called Bantama. That question, please. The solution has a little issues. So those who normally rely on solution to solve questions, that one you will face a little bit challenge. So the one I'm about to solve here is the one you need to use. And then that is all. Take me to Abrimpo on Bantama. Bantama is November 2016. This is November 2017. So go up to, jump up to, jump up to, jump up to November 2016. Is it this one? This Haruna. Haruna is May 2017. Haruna is May 2017 cash flow. Haruna. Take me to November 2017. Go down one. Is that this one? Question 5. No. Nima. Let me check. How are you going plenty? It's not like I see maybe inside though. May 2018. No, I don't want May 2018. November 2016. Oh, it's not here. Which one is this one? This November 2017. When I move one step further, May 2017. So go up again. This is May 2018 or so. This question. Diamond and shine. I know this question. Diamond and shine. No, this is May 2017. So go one step further. Go one step further. Good. So the one before this. There's an issue with the solution there. So please try and then that's why I have to explain with you. Let's go. Go to question 1. Good. That's when they drop the. This is the. What's them quadra so. That's where they drop quadra so.
Sir, please switch here.
November 2016.
Okay.
That question was a repeated question, though this is roadside. May 2015, a question that was released for level 3 was also released. It came in November 2016 for final level. The same thing appeared in 2015, May for level 2. That question was dropped 3 times at final level. It has been dropped once at level 2. I was expecting it to complete the game for me, but you'll be fine. Let's go this roadside. Yes, this question is another challenging question. Another challenging. Bantama and Abripo. Yes. So it's consolidated balance sheet. So when you start, what do? Let's go. Who can tell me what to do first? When you open the question now, you see something like this. What do you do first?
Sir, please, you start doing your additions. You write the name of the group.
Not
Then
at
you start doing your additions.
Not at all.
Hey.
What are you going to do first? Once you open. Who can come again?
So you check whether there is an associate.
Not at all. You are going too far.
Your group structure.
Not at all. You have jumped. I think that's the 3rd thing you have to do.
Sir, you write the name of the group.
That is the 2nd thing you have to do.
Hey.
You see the steps that we have to answer the examination question. First, you must read the requirement. Because you've not read the requirement, is it because you are privy to console? For all you know, this is not console question. For all you know, this ratio. So go and read the requirement first. That's the first you have to do. What did they ask? Prepare consolidated statement of financial position for who? Bantama group. So what do you do next after reading the requirement?
Yeah, the name of the group.
the name of the group, you do your three protocols, the name of the group, requirements, reporting currency. Then what do you do right after that?
You start adding this one.
Not at all. Cassie,
Hey,
you're
say,
watching how we solve question here.
I've been watching. No,
No. Right after writing, do we start adding up?
no, like you write it, and you open the brackets.
Cassie, I don't understand because of it that we said some questions. No. It's because of it that we said some questions. You see, right after reading the requirements, setting your tone, writing a Bantama group, whatever, you go straight to your workings. And do your workings 1, A, B, and C. You can tell me what goes to A, B, and C per ICA standard marking scheme.
Group structure.
Group structure.
Effective dates of acquisition.
Effective date of acquisition.
And then period of consolidation.
If you don't know this, you can start adding up because there are certain things that you may thought it is free, might not be free. That's the first thing you have to do. So now when you confirm this, you go straight and start adding up the numbers. Cassie, are you okay with this?
Sir, but I thought that since balance sheet, we don't prorate it. So you just go and add. Oh.
Okay.
Is there P&L that you do the workings before you come and do this?
This question, good. This question, I have to go a little bit further because there's something inside. Yes.
Say, when I was solving this question,
Yes.
I was so confused
Of course,
about
this question, whoever wrote it, we owe them apologize. Apologize.
Hey, the way I suffered before I got the retained earnings.
Oh no, that is why I have to solve with you. That is why they remind me for me to do because it's due for exams. Something of that nature. The Paladin question I picked, I thought is inside the Paladin question. So I should have come and used Paladin to solve this one rather. What I was looking for was not in Paladin. So that is that.
As scaring us.
No.
Mr. N,
Yeah, Cassie.
are you scared?
A little.
No,
Don't be.
no. Like, is it if I'm not told and it appears in exams, that is where it's dangerous. But now if you have been informed. And things I'm telling you, go and see them there. Like that. Say, hey. So he said it too. Now, let me run you through small with this question. Issues you have to do. Let me do all the workings for you. First, group structure. I'm on the group structure. So let's read. Bantama acquires 6 million of who? 6 million.
Sir, please, there's this black thing on your screen.
I've seen it. I've seen what is causing that. Is it gone?
Yes, it's gone.
Okay, so Bantama acquires 6 million of Abripos Limited's ordinary shares. On where? 1st April. So 6 million. So go and look for the number of shares of Abripos. Abripos has 8,000. So they have 330. So it will be 8 million. But that shouldn't be the number of shares. Check the share price here. The share price here is what?
1 CD.
So 1 CD. So it means that the number of shares should be 8,000 or 8 million Ghana cedis divided by the share price always.
Yes.
1. Those that they will always pick this figure. The moment we change this one from 1 to 0.5, you answered wrong. We have done some before. Final level.
There is a question like that. I think.
We've done plenty. That one we can't even count. Countless. Plenty times.
Now group.
And people were still using the figures over here because they thought this is the number of shares. Always don't forget to divide. If it's 0.5, divide by 0.5. That's that will tell the number of shares. So here the share structure, group structure. Let me do it here. Right here, parents. There are certain workings I have to do for this question because it's a bit complicated. I wish I have a little time to balance this question of I'll maybe not this trip. I'll have to solve it entirely and release it another trip. So group structure, right here the parent, Bantama. Right here, Abrepo. Right here, 6 million divided by 8 million times, and what do you get?
75.
NC automatically, NC will be what?
25.
Then number 2, effective date of acquisition. What's the effective date of acquisition?
1st April 2016.
1st April 2016. C, period of consolidation. This is how you have to write to. Fast.
30th September 2016.
Hey, period of consolidation is durational. So you
6
have to
months.
check the reporting date, right?
Yes.
30th September.
30th September. So it's 6
From-
months.
So 6 months, right?
Yes.
So 6 month consolidation. That is it. So that's the first thing you have to do. Then you go and do your consolidation parent per subsidiary, parent plus subsidiary in that nature.
So this one, let's do the workings. Then you go and do the
Yes.
main thing.
I'll do all the workings for you. Then you go and fix them in. Workings 2. Once there's balance sheet, everything is just standard. Don't jump any of the workings 2 should be cost of what? Consideration. Cost of consideration, read from the top and the first note. That's all. Top and first notes. It says that for an agreed consideration of 25 million, the consideration was settled by share exchange of 5 new shares in Bantama Limited for every 3 shares held in Abipo and a cash payment of 5 million. The cash consideration has been recorded, but the share exchange has not been. Good. So what you have to do is that you write here cash, write here share exchange. But whichever be the case, the answer should be 25,000. But please, all the workings, tell the examiner, all figures are in what? All figures are in
GHH.
thousands of cities so that we have peace. They told us that the share exchange is what? They told us that share exchange, the cash payment is 5. That means share exchange will be if the cash is 5, share exchange will be what? 20,000. The balance is
20.
or you can do the workings here, but let's see the workings. 3 shares, 5 new shares for every 3. So it will be 5/3 times the number of shares acquired. How many shares? 6 million.
6 million.
Times the current or share price of the parent. So sometimes here they didn't give it to you, right? It's a planting.
Yes.
It's a planting because we want some students. What they will do is that they will want to calculate it for us, but won't give it. Then they will guess their own figures. We'll mark them down. Instead of them using a balancing figure, like the way I've done it here, and be safe, they will come and say 5/3 times 6 million shares. Now they will not get the share price for us, and they can't continue the work. But it's a balancing figure. automatically go and add 20,000 to the stated capital of the parent because they say it has not been recorded. They say the cash consideration has been recorded, but the share exchange has not. So go and add it. Go and add it to the parent equity, the stated capital. So parent own, it will be 20,000 plus what? Another 20,000, right? Making 40. Workings number 3. So without reading the entire footnote, this is how you do it. But some people don't read all the footnote like 3 times. Oh ho. Net asset of who?
Sir,
Yes.
please come again. Where you add the 20,000 to the parents?
When you are doing the stated capital. If you
The
pick
group retained it.
no,
The
no,
group
then
retained it.
any show. We beg. When you pick the stated capital of the parent, you see, we don't consolidate the stated capital of the subsidiary, true or false.
True. Okay, so there's the share capital of the
The share
parent is
capital, you say
20,000.
20,000 plus what? The 20,000. Then you put in 40 in the group account. Agreed.
So why are you adding the 20,000 to it?
Because the parents have issued additional shares, additions of his shares to acquire the subsidiary, and he has not recorded it.
Sir, please, your screen is blocked.
Here is it. Let me. Sorry. Is it this question that they are bringing? Then it will be a disaster.
Hey, sir, this is what they are bringing.
Apart from 1 or 2 things that was facing, I was able to solve.
That's great. Now, look at something here. They say the share exchange has not been recorded. If parents issue shares, won't you record it?
Yes.
So the share aspect have to be recorded. And if you're recording, just add to the parent stated capital or parent share capital. That's all. Do you agree now or you don't agree?
I agree now.
Net assets of mention a person's name. Abripo. We are waiting for those that will write subsidiary. We did that max. Right here at acquisition. Right here at reporting. Right here post acquisition. Go straight to the balance sheet and record the balance sheet figures first. Don't bother yourself to look for at acquisition first. We beg you. It will discourage you. Question of this nature. If you try the at acquisition, it will discourage you. Encourage yourself in the examination room to solve the easy one. So go to the net asset, the equity side of the subsidiary. Pick the share capital, 8,000. Retained earnings. Sum up these 2 figures for me. 14,000 what? 14,000.
14,800.
Okay, so we have 8,000 and then 14,000. Name them share capital. No preference shares. So share capital retained what? Earnings. We are true. This is what I expect you to do first. And we now make assumption now. We now make an assumption that the share capital at the start, at the reporting will be the same will be the same as at the time of acquisition. So you just repeat your 8,000 here. Put a dash here. Now let's get the retained earnings at the date of acquisition. Go back to your workings number 1. Check the effective date of acquisition and check the reporting date. Here, I don't know. If you are moving, stop movement and understand this clearly. If you see any examiner and he has arranged the balance sheet like this, then there's a wahala. The retained earnings, it doesn't give you one figure. If you break it down, there's a wahala in a question. So take your time and assemble it well, especially to be a mid-year. So we want the year ended where? What did the year ended? Hello.
Yes, please.
30th
It ended
September.
30th
30th
September.
September.
So the year ended. Let me draw it here for you. Or let me go and do it on its own. If the year ended 30th September, 30th of September 2016, where would the year start from? Where would the year start from?
1st October.
1st October 2017.
Hey, have you seen?
Oh,
Hey, have you seen? How can you start from 1st October 2017 and at 30th of September 2016? How?
hey.
Yeah,
So the
Please,
year,
1st
so the
October
year,
2015.
2015.
yes.
That's where you have to start from. Unless when it's, I think last 3 days, when UK landing time, UK time and Ghana time is the same. I think around the 1 a.m. or yes, I think it was 1:59 a.m. What was going to the 2 a.m. The UK time went back. Then Ghana time came to 1 a.m. And then UK time went back to 1 a.m. and we all have the same time. Let me confirm. Current okay, so let's continue. So that's that. Yeah. So currently, Ghana time and UK time is still the same. It hasn't changed because recently we now use the same time. What a wow. Okay, let's continue. So now you start from 1st of what? October 2015, the next day of the previous year. That's the rule, the next day of the previous year. All right. When was the acquisition took place? Acquisition is 6 months, right?
Yes. And it took place on the 1st of April.
So this acquisition. Use month. How many months? Post
6 months.
acquisition period is what? Post acquisition. 6 months. Pre acquisition is what? Will also be 6 months. Now, here we want the retained earnings as at these dates. As I here. First rule, there are 2 ways of finding this. Now, rule number 1, get the retained earnings at the date of report. At the date of reporting. What's the retained earnings at the date of reporting? 14,800.
Yeah.
So write it here, 14,800. So pick what you call retained earnings at reporting. Then if I subtract, what's the profit made for the whole year? Bring the profit made for the whole year. It was stated in the question. That is why the examiner brought profit made. So for the year, this is the retained and the profit made for the whole year. It's 8,000 what?
800.
Good, 8,800. So the whole year profit is 8,800. Share it. 6 months to be what? And 6 months also do what? It can be 9 and 3, 4 and 8, 5 and 7. But here they decided to make it 6 and 6. So 6 month profit will be what? If the whole year is 8,000, 6 months will be what?
4,400.
And here also be what? 4,400. Now, if I want the retained earnings here, and whatever is here, they've added 4,400 to it before arriving at reporting. To pick the retained earnings at reporting 14,800, then you less post acquisition profit will take you back. Less post acquisition profit, which is 4,400. What do you get?
10,400.
Alternative, this is number one. So this is the retained earnings at acquisition. Alternative, this workings one, workings two. Check the open balance. If the whole year profit is 8, what's the open balance of their retained earnings? The examiner give it to us. You are even like you. Me, if I'm not setting the question, I won't give you. What I'll do is that
6,000.
I'll pass a note. The open balance is here is 6,000. I only
6,000.
pass a footnote in a question and tell that the profit made for the year is 8,800. That's all. And combine this figure. So even here, it's still not dangerous. It's still okay. There's still more dangerous ones ahead. So here, bring the open balance of the retained earnings. 6,000. Then what you do is that you add. So in that case, that one you add a pre-acquisition profit.
That's
Add what you
4,000.
call pre-acquisition profit. Pre-acquisition profits. 4,000 to it. You get 10,000 what?
400.
That becomes retained earnings at acquisition. Anyone you use, you are right. Agreed. This thing I've done, I'm very happy.
Sir,
Hey.
Yes, please.
only this place I took like 30 minutes.
Since November 2016, they've not done it for me. So maybe, for all you know, it is due for exams. So watch out. Watch out, Claire.
Hey.
Yes, please.
But you see the normal ones that we solve. No? Normally, when you go and take the sir, please go back to the question.
He said normal one. This one is not normal. Eh?
No. This is like this me for rich exam. So how then that you have to divide by this thing? Like, I'll just do what I know. Say, like you know, the normal ones, you take the 6,000, you take the 8,800. It will definitely be your reporting. You get your retained earnings at reporting. Then say you will come and take just your friend and say,
The
hey,
15,000,
you come and take just the
51,260.
6,000.
No.
Actually, don't confuse us. What we know is that once there's a mid-year and we're looking for the retainers, you are even lucky. Let me tell you the complex one. The one they should do for me, that I'll be very happy. This is how they should do it for me. This is the most complex one. Combine this figure together and call it 14,800. Then pass a footnote that the profit made for the year in a footnote 1. Profit made for the year is 8,800. So that one, the 6,000 is missing, right? The examiner have lost the 6,000 for you. So how do you get the 6,000? Then, to get an open balance of the retained earnings, subtract the entire profit made for the year from the 14,800 to give you the profit made, to give you the retained earnings at the beginning. So 14,800 minus the profit made for the year, 8,008. That will give you 6,000. Does that mean the open balance of the retained earnings is 6,000? Do you agree now? You don't agree?
Okay, fine. Say, then the Paladin question.
Paladin question, good. Paladin question.
It had the same thing.
Paladin question, it was the same, but check something clear. That is why you have to get your group structure correct. Paladin was a full year, not 6 months, not a mid-year. You need this working if it's a mid-year. If it's not up to 1 year acquisition, agreed.
If this one is not 1 year acquisition,
If
you
it's
have to do that plenty working that you did.
I didn't do any plenty workings. I did 2 alternatives. So you select one of your choice. His explanation has become plenty.
Yeah, please go back to it and let me see.
If it
I
is
now understand.
yeah, you only have to do one. All of them give the same answer. So you doing this, is it plenty? You doing this. Comparing 2 figures, 14,800 and 4,400. Or you do this, you get the same answer. You only do
Okay,
this if there's a balance sheet and it is what? And made what? Year. And retained earnings at acquisition will not be given to you. Let me give you the rules. Rule number 1. First, if it is a balance sheet, or if you are looking for a net asset, you are looking for net assets. Let me put it right here. Now, rule number 2. And it is a mid-year net asset, but the question is a mid-year. What's the meaning of mid-year? 6 months, 8 months, 9 months, 10 months, 11 months, up to 1 month. Again, then retained earnings at acquisition have not been given. At acquisition have not been given. That's all. These are the 2 rules. You need to go through what we are doing. So, Cassie, it's about you knowing that I need retained earnings at acquisition. They have not given it to me. And it's a mid-year and I'm looking for net assets. Then you have to pass through what I've done. Agreed?
yes, please. So say if it was 9 months, you just take the profit for the year and you times it by 9 over 12. Then you go and add the answer to the
The opening balance.
to the opening.
Relax, Cassie. There are 2 different methods. One we are adding, one we are subtracting. So know where you are coming from. The first one we are subtracting, the second one we are adding. And the starting point are not the same. So if it is 9 months, that means here will be 9.
So I'll take the first method.
First
Because
method.
the first method, no, I know my I know my reporting.
Good.
So this one, I'll come and take 9 over 12.
That's all.
Times the profit.
Then you subtract.
Then I'll less it from. Oh, okay.
Yeah.
Okay.
That is
So
what.
thank you.
This is what we mostly do. The reason why I picked Paladin is that I thought Paladin it's a mid-year. Not only Paladin is not a mid-year. And if the question is not a mid-year, if the question is a full year, everything here is the same. It is net asset, but it's a full year. It's a full year. You don't need to go through this. Full year, don't go through this. Pick only the retained earnings at the beginning of the year. That's all you are good to go. Retained earnings at the beginning of the year is the same at acquisition. Or a full year, don't need to do all this. I'm done. With the retained earnings figure at acquisition, 10,400. What's the post acquisition? The difference?
4,400.
That's all.
Say, with the retained earnings, how do you know if this one has to be in brackets or not? Or retained earnings should never be in brackets?
Okay, retained earnings, it can only be in bracket if it's a loss in the question. If in the question itself is bracketed, that's what you put in bracket too.
Oh, okay. Thank you.
Now let's go straight to the next show. What do you have to do? What do you have to do? Go to the footnote and read fair value adjustment. 11 3 things you are done. 1. fair value adjustment. 2, unrealized profit. That is if the subsidiary is the seller, if Abripo is seller. 3, unrecorded transaction. Only 3 things per. Only these 3 things per will affect this net asset. So in the footnote, that's all. If you read, there are nothing like that, you close it and go. But definitely there'll be something. Anybody that wrote this question, we owe them unqualified apology. Let's go to the notes. Note 1. The fair value of the Abripo's Limited's land at the date of acquisition was 4 million in excess of its carrying amount. Abripo Limited financial statement contain a note. Don't continue. There's another mistake students do in exams. Have you seen this note? When you are reading, you see a full stop. You have to stop and analyze what you have read first. Many people will not do it. They want to finish the entire note before they analyze it. By the time you finish the entire note, you have forgotten about the first one. You have to go and start and read again. And the more you are reading, the more time you are taking. So that's why a question that you're supposed to finish, you won't finish in exams. Because first mistake, they read the entire story. And when they finish, they start reading it again to pick what they have to do. No. You read a sentence, you stop and analyze that sentence. So even if that's what you can do, move on and go to another one again. They say fair value of Abripo's land at the date of acquisition was 4 million in excess of its carrying amount. So this fair value adjustment, true or false? Right here, fair value adjustment. And right here, land. They say 4 million. Write the 4 million here. Then check. Ask yourself, have they recorded it? Here, if nothing was said, nothing was said, bring it here again. If something is said that it has been recorded, don't bring it here. Take notice. If nothing was said, bring it here. If something is said that it has been recorded, don't bring it at all. That's all. These are the things you have to take notice of. So let's go and check whether something is said or nothing was said. So they say full stop. Then they open up a different storyline. Abripo's financial statement contain a note. No, we don't want that. Nothing was said. So nothing was said. What do you do? If nothing is said, what do you do?
You have to record it at the reporting.
Thank you. So bring it the same figure here, 4,000, and through dash. Now, anytime you pick something from the footnote and record it at reporting, go to the face of the balance sheet and add it. So on the consolidated balance sheet, the PPE, add 4,000 to it.
Yes.
Add 4,000 to the PPE, so plus 4,000. When you're adding all of them. Good. Next footnote. So that first sentence, you are done entirely. If that's what you can do, it's far better than to read the entire sentence and come back and come and look for what you have to do. No. Please, you are not computer. You are not AI. You are a human being. You are not artificial intelligence. We beg you. So read it sentence by sentence. It says that Abripo Limited. It says Abripo's Limited financial statement contains a note of a contingent asset for insurance claim relating to some inventory that was damaged by flood on 5th of March 2016. But then we acquired Abripo 5th of March 2016. But then we acquired Abripo. We acquired him first of when we acquired Abripo. Let's go up. 1st of April 2016. So there's a contingent asset. Okay. The insurance company is disputing the claim. Bantama Limited has taken a legal action on the claim and believes that it is highly likely that insurance company will settle in future. So here, what do? If they will settle the money to us in future, then it is what you call an asset that you have to make a provision for, because we are highly probable, highly likely that they'll pay the money to us. So the insurance claim is an asset, a current asset. 2 entries is in the footnote, so 2 entries. Number 1, add it to the net asset of our report, both at acquisition and at reporting. You see here, they say the financial statement contains a note. The financial statement, it contains a note. So does it mean that they have recorded it in a financial statement? Since when a note becomes a financial statement item? So take note. So please record it as an asset, additional asset. Let's go and add it to the storyline. So add it to net assets and add it to current assets, please. It's a receivable. So let's go and add it to net assets. So right here, fair value adjustment, still right. Insurance. 800 here, 800 here. Dash. Go to the current asset and add it to receivables. Add it to receivables on the consolidated financial position. We are done. Next. This footnote, this one, we are done with this note entirely. Note 2. At the date of acquisition, Bantama sold an item of plant that had a cost of 2 million to Abreport for 2.4. Abreport has charged extra depreciation of 240,000 on this plant since its acquisition. What do you have to do? First, please, anytime there's disposal of PPE, let me take my time and walk you through. When there's transfer of PPE, sale of PPE at a profit, sale of PPE at what? A profit. Number 1, eliminate the profit holding. Profit holding, not the loss holding, no, profit holding. 1, subtract it from the seller's profit. If it is parent, group retained earnings. If it's the seller is NCI, or not NCI, subsidiary. If subsidiary is the seller, subtract it from net assets. Number 2, subtract it from PPE. That's the first workings you have to do. So let's do it. So calculate the profit loading. That's the first thing. What's the profit loading? How on earth you have an item that cost you, that has a current amount of 2 million, and you sold it for 2.4. What is the profit on the sale? What?
Sir, please,
100,000.
0.4.
That would be 400.
Yes.
The 400,000 first workings. Who made the sale? Who made the sale? Who made it?
Bantama.
Bantama made the sales.
So Bantama is the parent. So he made the sales. So therefore, where is Bantama's profits calculated? Group retained earnings, right?
Yes, please.
So go and subtract 400. Call it unrealized profit from group retained earnings, 400. Second, go to PPE and subtract 400 from PPE. That's all. It ends there. That's first workings you have to do. Do you all agree or don't agree? So minus 400. Second entries you have to do. Then you are done. Second requirement. You must eliminate any unrealized profit. Sorry, excess depreciation charge. Excess depreciation. Sometimes the examiner will not give it to you. First, calculate it. The calculation is equal to the profit made divided by the remaining useful life, number of years, times period of consolidation, or from the sale time up to the reporting date. But here the examiner said it's 240. Two entries. What are the entries? Number one, add it back to the buyer's profit. The buyer who bought the asset. Who bought the asset?
Abrepo.
Go. So add it to Abrepo's profit. So where is Abrepo's profit calculated? Net assets. For Abrepo. Then working number 2, add it back to PPE. So let's go and do that. So go to Abrepo's net assets and write. The name is called excess depreciation. But even if you cannot call it excess depreciation, just write depreciation. Don't bring it here, 240. You're adding back. Here's also 240. Go to the face of the balance sheet and then you add it there to PPE as well. That's all. It ends here. Do you agree or don't agree?
Say.
Sir, please, how will you know that? See, some of the depreciation, we subtract it from PP. So, sir, how will you know that this one you have to add it back? I don't know how we calculate the excess depreciation.
Okay, let me explain.
It will confuse me a lot.
Let me explain. I've done a full video on this on YouTube. It will do a justice to this, but let me explain further. Now, when you sell an asset to someone and you make a profit, we have eliminated the profit. The person who bought the asset, which is a report, now the buyer of the asset, he will depreciate it on the larger amount, on the 2,400, instead of depreciating it on what? On a lower amount of 2,000. So he will calculate depreciation more. That is why we are eliminating it.
Oh, okay.
That's why we are calling it excess depreciation. You should have depreciated on the cost without profit. But because you sold to him at a profit, he also select this figure as his carrying amount or cost and depreciate it. So he has depreciated it more. So it will create what we call excess depreciation. That is why we are adding back. So if you have, and depreciation is an expense. So if you are charged more expense than you're supposed to, then we have to go and add it back. And expenses, depreciation has been subtracted from the profit, at the same time subtracted from that of the carrying the PPE figure. So that is how it is.
God bless you, sir.
I hope you understand it. So that's how it is. With this, I've done a full section on the YouTube there. So you can look at it to add more to it. I did a more on it. All right, so let's continue with the game. So that's how it's supposed to be. However, let me wait the case. Have you seen fair value adjustments? With fair value adjustments.
Yeah.
If it's again, fair value adjustments again, and it's a depreciable asset. It's a depreciable asset. It will create what you call additional depreciation. So that one, normal depreciation, what do? You subtract. But if it's a fair value loss and it's a depreciable asset, it will create what you call excess depreciation, which must be eliminated. So when there's a fair value adjustment, is a loss, take notice. The depreciation aspect is called excess depreciation, and always it must be eliminated. That one you add. as a positive figure. Agreed. So don't put
Okay,
it
so
at the
say,
back of your mind that always depreciation is subtracting, we are adding. No, no, no. Look at the situation at hand.
okay, so say that's when they will say that the fair value is below its carrying amount.
Good. Fair value is below its carrying amount. And if it's a depreciable asset, its depreciation should be added both at the net asset and at the PPE.
PP. Okay, okay.
Okay, so we are done. Do you all agree or don't agree? So
So we agree.
I'm done with this particular footnote. So go and add it to PPE. Let's go to the next footnote. Now, on this note, we are done with this entirely. I'm done with this entirely. Bantama, let's go. I love this note. I love this note. All right, so let's go. He said, look at this. At the date of acquisition. No, down. Note 3. Bantam's current account, debit balance of A2. When you say debit balance, it means what? Is it receivable or payable? Is it receivable or payable? First online, which of them have a debit balance? Hello?
Receivable has a debit balance.
Of course. So as and when they say the current account, any owing transaction between parents and their subsidiaries or between the members of the group is recorded in what you call current account. So if you see current account, it represents a debt owing among the group members. Agreed.
Yes, sir.
Cassie, are you there? Okay, let's move on. So, if on parent financial statements, here, let me do it here for you. This working, I'll do it here. Let me check something. But you see, I have to complete my, before I start all these complicated workings, I have to complete my net asset first. So I have to read through. Let me give you a secret before I come to this. To be able to know that you are done with your net asset, come back. This is where we are. I want to complete it before I start anything. What you have to do is that go through the rest of the footnotes where they've mentioned a report. Read it and see whether it will affect its net asset. That's all. Then you close the net asset so that you can go ahead and do some of the workings. Here they mention a report, but this one it will not affect the net assets. Okay, there's another admin. It will affect net asset. There's admin cost to affect net asset. Yeah, I love that. I love that. I love that. Good. So that means you have to treat this note entirely. So I'm going to treat this note entirely with you. Let's read it slowly. Bantama Limited's current account debit balance. So Bantama is a parent. Right here, Bantama with the parent. You have a parent. They said debit balance. Debit balance means receivable. His receivable figure is what? 820. with Abriport Limited does not agree with the corresponding credit balance in the Abriport's books. So go to Abriport. It's not balancing. It's not balanced, so it's not the same. What's the difference? So right here, payable. It's not balancing. Investigation revealed that on 26th of September, few days to the end of the reporting date, Bantama Limited charged Abriport Limited 200 for each share of what? Central administration cost. Abriport has not yet recorded the invoice. What? So first assumption, you assume that, you see, it means that subtract 200 from 800. What
Yes.
Abriport is owing is what?
800.
It's 620. That's why it's not
620.
balancing. Because you see, this is how it is. Let me break it down. In fact, this one is another a challenging area. Let me break it down. When I do with current account, when it started, Abriport, this is the Bantama and Abriport. Here it will be called receivable, 820. Here to be called payable. You see, subsidiary is aware that I owe parents 620. Parents say, no way, I don't owe me 620. I've forgotten. I've forgotten that I've charged you with. There are three things you must know: cash in transit, goods in transit, and expenses in transit. These are the three things that cause imbalance between the current account. But this one is X. So that is that. Now next is because the parent has invoiced an expense to Abriport and Abriport have not received it. Because parent is the one who did the calculation, he has accounted for it. But because Abriport have not received it, so first assumption, assume that the recipient have received it. Assume that what? Assume that the recipient have received it. So please, if you are there, you are the accountant for Abriport, and then the head office have charged us with an expenditure of 200. What will be the accounting treatment? 2. Tell me the 2 accounting treatment. Number 1. Please tell me the 2 accounting treatment. So that I ran away.
A question again.
You are the group accountant. You are the accountant for Abriport. And you are there and they said that the head office have charged us with an expense, admin expense of 200. So you have received the invoice. You have not paid. What are the 2 entries involved?
So you
Number 1.
debit.
You debit, you debit your
You
P&L,
debit
2 of us.
your P&L.
And you credit
Yes.
payable. Because you know
Payables.
so debiting P&L means you add it to your expenses. Payable is here. So add payable, add it to payable. You are adding 200 to payable. Do you agree now? Then number 2, you add it to your expenses.
Expenses.
Adding it to expenses, it means come and add it to the net asset.
Net asset.
So here, say central admin dash 200. No prorating, we beg you. We don't prorate expenses, cash, goods, and transit. No prorating, we beg you. Subtract it here. Subtract it here. The other corresponding entry. Go to the payable. Add it to payable. Go to payable and add. So when you are doing your group structuring, payable figure, add. There's a long and shortcut approach. Follow and be fine. To add. So here, payable plus this plus 200. Then now it has balance. So now everything, it has balance, right? If it has not balance, you can never eliminate it. Now that it has balance, you can now eliminate it. Now that it has balance.
So go and take it from your trade receiver.
Both trade receivable and
Payable.
So when you go, the same account again. The same place. Now minus 820. Receivable, go to the top. Receivable, why? Yes. Minus 820. So that's also indirectly, you are adding 200 subtracting 820 from payable. It's not the same as you subtracting 620.
Yes.
That's it. That's a shortcut. Though when you go further, I did a lot of shortcuts. That is all. So on that note, we are done with this footnote fully. It can be goods in transit, cash in transit. Scan through the rest of the note and see whether Abipo's name will not be mentioned. Hey, Abipo again. Dividend. This dividend is another Wahala game. We call it. Then impairment.
Please go back again.
If now arrive where do I go again?
Hey.
So this note we are done. We have note 4. Dividend to now affect net assets.
So say yeah, some more. Hey.
So do not affect net asset at the year end impairment review. Impairment will not affect net assets. So therefore, we are good to go. So close the chapter of net assets. Close the chapter of net assets.
Sir, please take the dividends again.
We've not even started though.
Hey.
The dividend will go to retain
Look at it. Add everything together for me. I'm doing the workings for you, so you have to go and put the pieces together.
23,200.
23,200, right?
Yes.
Good.
Then 27,640.
Okay, so can you take it again? 23,000.
200.
And here will be
Some coming 27,000. 4,000 minus 200 plus 240. 27,640.
27,640.
Sir, please, the negative 200, where did we get it?
The dozy one has wake up. Okay. We had it. I think that's the last working we did. The work we just did. The central admin one. The central admin one. So take notice of that.
So the post-acquisition profit 4440.
4440. Okay, so that is that. So it's 4,400 and what?
4,440.
444 3 like this. Okay, I'm done. So Cassie, we had a 200 from this particular note. Where is it? This one. We add admin expense, this 200. That's all. And then we are good to go.
Okay, sir, thank you.
All right, so last but one footnote. Then once the net asset is completed, what do you do again? Almighty what?
Well,
Sure.
goodwill.
The one net asset is completed. Let's go to goodwill. Workings number what?
4.
Start by saying consideration. Cost of consideration. Workings number 2 is 25.
Yes.
Check and see whether there's NCI or there's another note here. Let's
So the pre-acquisition profit.
this note. Let's talk. This note was also another wahala, but you'll be fine. They give us the NCI at all. Have I seen NCI in this question? Let's give us NCI, NCI. They give us NCI. Nothing was mentioned. No NCI. If no NCI is mentioned, what do you use? Use net asset method. Agreed. Use the proportionate interest method because they didn't mention NCI or they've mentioned it and not C. Oh, they even said it here. It is a group policy to value non-controlling interest at acquisition at its proportionate share of fair value. Oh, you are. So let's summarize this note. It has, they say, Apripot paid dividend of 400 on 30th September 2016. Profit and dividend earnings. Profit and dividend earnings of 8.8 million for the whole year. So that's a profit. This is a profit. You see, the profit is here 8.8 million, out of which I'm reading from somewhere. Let me start the whole show again. I think I'm seeing stars. Now, it said that the profit and dividend of Agripop are deemed to accrue evenly throughout the year. Agripop's retained earnings is 8.8 for the year to 30th September 2018, shown in its statement, as shown in its statement of financial position, is after the deduction of the dividend. Bantam's policy is to credit this to the income, only those dividends received from post-acquisition profit. Bantama Limited has not yet accounted for the dividend from Agripop, even though the check has been what? Received, but not banked. Now, take your time. I've issued a video on dividend. There are two types of dividend. You have to go and look at it for me. We have dividend at acquisition, pre-acquisition dividend, and post-acquisition. Please. It does not mean that we are paying dividend during the pre-acquisition, because if the subsidiary is paying dividend at the time that you have not acquired him, please, will they give you some? Will they give you some of the dividend?
No.
Good. So take note. So when we say pre-acquisition dividend, all what we're trying to say is that the money that we used to pay the dividend was earned during the pre-acquisition. That's the meaning of the word pre-acquisition dividend. It's like marrying someone that the family members are saying that instead of the man have to buy everything, the subsidiary, that is the woman's family, says that, oh, don't worry, we already have some land or some cash, use it. That's what you call pre-acquisition dividend. So they are giving you earnings from profit they've made before you guys met. In that case, pre-acquisition dividend, calculate it, subtract it from where? Your cost of what? Consideration. So it will reduce the total bride price you are going to pay. Do the calculations work. Imagine you are paying 20,000 and they said that, oh, we are giving you a car or you are giving you a land at least at the cost of 15,000. And meanwhile, you paid 20,000 to these people and they are giving you something 15. So indirectly, the actual amount to pay is what? 5,000. That's what it means in consolidation. You see, make it practical. I always say that financial reporting and corporate reporting is something, it's a real life. That's all. It happened. Recently, Kennedy, I think Kennedy's daughter want to marry. Pre-acquisition dividend wanted to take place, but Kennedy said he will not do it. Kennedy said he will not do it. I think, you see, when despite sons and daughters are married, despite show off with cars, luxury cars, gift to the opponents. So during the Kennedy's time, the man asked Kennedy that It's coming spoil the wedding with what? Luxury vehicle. So I bought them. Okay, I remember. Miss Hansom Emma Los Vicas. Hey, incredible stone. Oh. So it didn't work. So pre-acquisition dividend did not work. Incredible consolidation. But in despite and co, it worked. Aliko Dangote, it worked. So that is how it is. How do you calculate it? It's a bit critical. The calculation is very easy. Step 1. Divide the dividend into 2. Into pre-acquisition and post-acquisition. That's all. First workings. Divide the dividend into 2, pre-acquisition and post-acquisition. So go to the question. What is the total dividend? What is the total dividend paid?
Sir, please, 400,000.
Divide it into 2.
200,000.
And post-acquisition. 200, right?
Yes, please.
Now let's focus on the pre-acquisition. Now take step 2. Take parent share. What is parent share?
75%.
So take 75% of this figure.
150.
150. This money should be used to reduce parent cost of consideration. If you are a man, you are going to marry somebody's daughter, and the family said that they are dashing you a car, they are giving you something, please. It will reduce the bride price. Whatever you paid, you have gained something. Have you seen? But this didn't work at the Kennedy side. Yeah. So that is all. So third exam now pre-acquisition dividend. Less pre-acquisition dividend. I'll finish very soon. Pre-acquisition dividend. So do your calculation. How do I do a calculation? 6 out of 12 times 400. That will give us 200 times 75%. That will give us what? It is 150.
So, sir, please, in case that this one is not half, is it always half, or it depends on this one, on the period of consolidation? So, sir, let's say the period of consolidation was 9/12. That means the pre-acquisition would be 3/12, right?
Yes. Here, take the pre-acquisition period. It will be 3/12.
Okay.
Good.
Okay.
That's so excellent. Please, it will reduce. We subtract. We don't add. It is reducing how much you are paying. Agreed. This how much are you getting?
Two for 850.
Go 2 for 850. I'll take that 2 for. Then say net assets, share of net assets at acquisition. Open a bracket, 75% of the net assets. 23,200. What do you get? This is what you get.
17,400.
17,000.
400.
You take it off. What do you get? What's the goodwill?
7,450.
7,000.
450.
Now, if goodwill is negative, what do? You add it to group retained earnings. Take notice. We call it negative goodwill. Let me explain.
Yes,
Anytime
bargaining
you have
purchase.
it's negative. Add it to group retained earnings. Then let's go and check whether there's impairment in the question. On our notes
Yes.
from here, the rest is normal consolidation. Is there impairment? Oh yeah, there's impairment here.
There was an impairment. 595.
595 was identified. That's all. $595. What do you get?
6855.
16.
No, 6855.
So that's a good rule at reporting.
Yes.
Good rule at reporting. So we are done. Okay, so once you are done, the next one is NCI. This is NCI working number what? 5 NCI. NCI, please let me do the shortcut for you. Okay, this is proportionate interest method. Multiply 25% times the net asset at reporting.
$23,200. It gives you 5,800.
I'm not agree. I'm doing a shortcut approach, not a long approach.
Sir, 25% of net
Net asset
assets at
reporting. Yeah, let's do the normal way. Let's go. Let's do the normal way. Fair value of net assets at acquisition. 25% times what?
23,200.
200. I want to finish early.
5,800.
Then add what? Share of
Post-acquisition profit.
acquisition profit. 25% of what?
4,440.
What do you get?
1,110.
In all, what do you get?
6,910.
It's the same as you multiplying the 25% by the net asset at reporting. What's the net asset at reporting?
27,640.
You should get the same answer as this.
Oh, okay.
So that's what I wanted to do. So that I ran away. All right, so I'm done. The rest is for you, please. You're going to do next.
Sir, please, can I see the goodwill side?
Sir, do you know something?
No.
Let's do the group retained earnings, then you go. I want to see the retained earnings, how you do the retained earnings, just the retained earnings.
Just the group retained earnings.
Yes, I want to see the retained earnings.
Right? Okay, so that's the last working, then that's all. If I do that, then that means I've solved the question fully.
Yes.
Group.
I said there was no investor, associate.
Yes. Group retained earnings. Let's go. Right? Bantama. Right? I report. I report is 75% of Bottom's own is from the question.
So you get 3330.
So let's go. Now pick the retained earnings of the parent. That would be adding the two figures together. Some of them bulk them up for me. Normally I don't have time. I bulk them up. 51 260 plus 13 200. Answer.
64,460.
Time no day. Bulk them.
94.
Open a bracket and then you put them together. So you said you had what?
64,460.
64.
Yes.
900 and what?
460.
Then this one you say had 3, plenty 3.
Yeah, 3330.
Okay. Then you now go ahead with all the stuff we have mentioned. First one, don't forget impairment.
Sir, this place, why is it that the impairment was not shared?
Because the goodwill is also not shared. The goodwill is proportionate. Impairment must also be proportionate. If the goodwill is fair value or full goodwill, impairment must be shared. Agreed.
Okay, sir.
So entire impairment 595 or so.
Yes.
Then the next item you have to pick is that
The provision for unrealized profit.
all those ones.
The 400. Yes.
So let's go and then put those ones in. Then 400. No, unrealized, yes, unrealized profit on I normally call PUP. Provision for
Yes.
unrealized profit, 400.
Then the dividend. Pre-acquisition dividend. The 150.
The post-acquisition dividend, not pre-acquisition. Oh.
Post-acquisition
And
dividend.
you know why we are treating it here? Look, that video there, everybody must go and watch. I've done dividend entirely. How dividend should be dealt with. You see, parents have not recorded anything at all. He has received a check, but nothing has been done. Once he has received a check, the entire parent share of the entire 400, that will be 300, right?
Yes.
150 from the pre-acquisition side, 150 from where? Post-acquisition. Because it has not been recorded at all, parent must capture it in his retained earnings. But if parent has recorded, you do nothing. You over here, you do nothing. Go and look for that video. If you want it, right after this, say hi. I'll send that video to you. Everything you know about dividend. So right here, post-acquisition dividend. That should be 150. We are adding. Which one again? I think that's all for this question. Add everything together. Then when you go to your cash, add cash or bank. They say check. Check they say the cap cash, the cap bank. Check you have the bank. Oh, thank God the examiner said cash and cash equivalent. Add 300. That's the pre-acquisition 150 plus what? Post-acquisition 150. Add 300 to it. On that note, we are done with this question entirely. That nothing else again. Put all the pieces together, balance it, and send it to me. Those that will do smart exams. What do you get if you add all of them together?
69,900.
All right, so 69,900 and
I'm coming. 945.
all right, so that is right. Agreed. So on that note, we are done. So if you put the pieces together, you should be able to balance. Do you want to balance it?
Sir,
Yes.
please, I want to ask a question. With the dividends again. So, sir, when you do the sharing now, do you get it? Based on the period. Like this one, like this, it was half. Do you get it? So when you do it, then you add one to which one? Where did you? Hey, I'm coming now. Sir, please, I'm coming. Let me get this one straight. So when you do the dividend now, then you add one to
I want you to use the terms for me. Which dividend?
the pre-acquisition.
Good. Where is it going?
The pre-acquisition, you less it from goodwill. And the post-acquisition, you add it to parent group retained earnings. Sir,
Yes, that's all.
just that you don't do anything in this one again.
Where?
In the balance sheet, you don't do anything to it.
No, what do you want to do again?
Okay, so then that is it. Then I'm okay with the dividend.
All right, so on that note, I'm done with it. When I see you again, all the best in exam. If you don't hear from me again, all the best in exams. But I'll see you again.
Hey, sir, like that.
Sunday, we are meeting from 4 a.m.
Sir, Saturday.
No, today is when?
Friday.
No, tomorrow I'm not meeting you.
Tomorrow we are not meeting as a Sunday.
I'm meeting on Sunday, 4 a.m.
Yes.
up to 4 a.m. up to 10 a.m., right? Or to 12?
Yes, please. You meet us in the morning.
Good. So that is
I
all.
think I send the timetable to you.
All right. So
And sir, please, what I said. So we are done with